Did you know that one of the most powerful tax breaks ever handed to small business owners is quietly sitting there in 2026? And most people have absolutely no idea if they still qualify. We're talking about the qualified business income deduction, a provision so misunderstood that accountants are getting calls in a panic every single tax season, wondering if it disappeared overnight. Here's the thing. It didn't disappear, but it's been living on borrowed time. And that tension alone should have every self-employed person, landlord, and S-Corp owner leaning forward in their seat right now. The QBI deduction was born out of the Tax Cuts and Jobs Act of 2017, designed to let pass-through business owners deduct up to 20% of their qualified business income, essentially letting you pay taxes on 80 cents of every dollar you earned. Think of it like the government quietly sliding a coupon under your door and never telling you it was there. Except this coupon is worth potentially tens of thousands of dollars, depending on your income level. The whole idea was to level the playing field between corporations, which got a permanent rate cut to 21%, and the solo entrepreneurs and small business owners who power the economy from their laptops and job sites. But here's where it gets interesting and a little ironic, because the deduction was never made permanent. It was set to expire after 2025, which means heading into 2026, everyone from your neighborhood contractor to your friend who runs an Etsy shop is wondering if the rug just got pulled out from under them. As of now, Congress has extended the deduction through legislation tied to broader tax negotiations. So the deduction is still available in 2026, but the rules haven't gotten simpler, they've gotten more layered. You still need to qualify, and that process involves income thresholds, business type classifications, and W-2 wage tests that can make your head spin faster than a tax code footnote. Let's break this down, because the misconceptions here are genuinely hurting people who deserve the benefit. If your taxable income is below approximately $194,000 for single filers, or around $388,000 for married filing jointly in 2026, you likely qualify automatically if you run a pass-through business. No strings, no extra hoops. Above those thresholds, things get thornier, and this is where the specified service trade or business classification becomes the villain of our story. If you're a doctor, lawyer, financial advisor, or consultant, the deduction phases out and eventually disappears entirely as income rises, which is the tax code's very on-the-nose way of saying we like plumbers more than we like hedge fund managers. Ironically, real estate investors often fare extremely well under QBI, especially when they can demonstrate regular and continuous involvement in their rental activities. And that's not an accident, that's a structural advantage worth knowing. The Section 169(9) regulations allow qualifying real estate professionals and active landlords to potentially capture that full 20% deduction on rental income, which is the kind of thing that makes a good CPA worth every dollar you pay them. Historically, tax provisions like this follow a cycle. They get introduced with fanfare, get underutilized because of complexity, become politically contentious, and then get quietly extended or modified in ways nobody tweets about. We've seen this with bonus depreciation, with Section 179 expensing, and now with QBI, the pattern is almost comedic if your money weren't on the line. The practical lesson here is not to assume you don't qualify just because the rules are complicated. That assumption costs people real money every single year. Run the numbers, or better yet, let a qualified tax professional run them, because the deduction scales with your income and business structure in ways that are highly individualized. Discipline in tax strategy looks like this. You don't wait until April to ask whether you qualify. You structure your business decisions all year long with the deduction in mind. That means tracking income carefully, understanding your W-2 wage base if you have employees, and potentially adjusting entity structure to maximize the benefit before December 31st. The philosophical truth underneath all of this is that the tax code rewards people who pay attention not because the system is fair, but because it's navigable if you're willing to engage with it seriously. Conviction without process is just hope, and hope doesn't file your return. So whether QBI sticks around in its current form, gets modified, or eventually sunsets for real, the right move is rational preparation. Know your income bracket, know your business classification, and work with someone who can model the outcome for you before it's too late. Comfort with uncertainty comes from having done the work, not from crossing your fingers and hoping the tax code blinks first. If you want to get started in real estate investing, need home contracting work, or are looking to connect with the right lenders, check out our links in the description below.